We are getting some breaking news here on GameStop and the SEC. Bob Pisani with the details. Bob.
Hello, Sarah. The staff of the SEC has released a long-awaited report that focuses on the meme stock craze that peaked in January of this year, particularly the trading activity around GameStop. Now, what caused all that volatility? The report examined institutional accounts that had very significant short interest in GameStop, and it concluded that while short covering was a factor, it was a small fraction of the overall buying volume. The staff instead concluded it was positive sentiment, not short covering, that sustained the weeks-long price appreciation in GameStop. The commission staff did consider but rejected other explanations for the price rise, including naked short selling and a so-called gamma squeeze. Now, what, if anything, should be done? The report is long on facts, but it's short on recommendations. For example, the report noted that some brokers, particularly Robinhood, experienced margin calls from its clearinghouse when GameStop's price spiked up. The authors suggest shortening the settlement cycle, currently 2 days, to 1 day or less. The report also urged the commissioners to consider whether game-like features in trading apps might lead investors to trade more than they would otherwise. On the issue of payment for order flow, the report noted that the wholesalers who executed those orders did so internally, and so their trades were less visible to the wider market. On the issue of short sales, the report said that improved reporting of short sales would allow regulators to better track what happens when short sales do occur. Still, investors expecting some kind of imminent action from the SEC are likely to be disappointed by this report. This is a staff report. It outlines the facts, but it contains only very general recommendations on what the SEC commissioners might do. And guys, it doesn't contain any particular recommendations on what rules the SEC might want to enact in the future. Now, Chairman Gensler has spoken about payment for order flow and gamification of trading as talking points for months now. I think the issue with this report is, while it mentions this, it doesn't draw a clear conclusion and doesn't clearly show that there's harm from what happened in GameStop and, for example, payment for order flow or gamification of trading. We'll have Gary Gensler, by the way, the chair of the SEC, on with us tomorrow, 9:35 a.m. Eastern Time on Squawk on the Street. Guys, back to you.
Bob Pisani, thanks so much.